Any retail trader sitting at home now has 24/7 access to the exact same economic headlines that once lived exclusively on institutional Bloomberg terminals. Algorithmic systems and AI now process millions of these data points every single second. It is a relentless, high-frequency flood of information. This abundance of data often creates a state of macro paralysis. Investors find themselves pivoting their entire portfolio strategy based on a single beat or miss in a daily payroll report. A disciplined framework is necessary to synthesize these numbers. Without a cohesive model, every economic release remains a disconnected event, an isolated shock rather than a data point within a larger system. Having the fastest newsfeed no longer provides an informational edge. Without an organized methodology to interpret the noise, traders remain vulnerable to daily market volatility. Financial media constantly fixates on data points that are easy to narrate. Gross domestic product and the monthly unemployment rate dominate the daily headlines. But for a forward-looking investor, GDP is a rearview mirror. It only confirms economic activity that has already happened. By the time a recession is officially verified in a GDP print, the market has usually already priced in the next phase of the cycle. The labor market is equally misleading because of labor hoarding. Since firing and rehiring workers is expensive, companies wait until a downturn is undeniable before cutting staff. Employment is often the absolute last sector of the economy to crack. Waiting for the unemployment rate to spike means reacting to the result of an economic contraction, not the cause of it. Building a strategy around GDP and labor statistics structurally positions you for the wrong phase of the economic cycle. You are attempting to drive while looking only at the road behind you. Financial markets are discounting mechanisms. They price in the collective expectation of what the world will look like 6 to 9 months into the future. This timeline shows the chronological flow of data. Gaining an edge requires leading indicators like PMIs, inventory cycles, and housing starts. Declining building permits trigger a predictable cascade, slowing construction and retail spending months before the broader economy feels the impact. No single variable functions in a vacuum. A Federal Reserve rate cut means something entirely different during stable growth than it does during a period of rapidly decelerating credit and a deteriorating labor market. Determining where the macro cycle is heading in 2 quarters is the only way to avoid the trap of isolated single variable thinking. To filter this noise, we utilize an operating system distilling chaos into 5 tested pillars. We call it the Logic Macro Regime Framework. L stands for liquidity. It is the primary driver of asset prices. We look beyond domestic policy to track global liquidity, specifically the China credit impulse, which ripples through global manufacturing and commodity markets. O tracks other financial conditions. This measures the actual cost of money through metrics like the US dollar and credit spreads, which determine if the channel is open for liquidity to flow. G is for growth. We focus on forward-looking growth diffusion metrics from the OECD to identify the direction of travel for the global business cycle before it shows up in domestic reports. I analyzes forward inflation dynamics and price persistence. Finally, C monitors capital positioning and risk appetite, identifying when a macro narrative has already been fully priced in by the market. These 5 pillars are the gears of a macro machine. As they interlock, they identify the broader environment, whether that is a Goldilocks regime of accelerating growth or a stagflationary window. This engine translates chaotic, contradictory variables into a coherent roadmap, revealing the structural direction of the global cycle. The raw information edge has vanished. Modern competitive advantage belongs exclusively to the expert information synthesizer. Systematically organizing data allows you to ignore daily narratives and clearly see the connections between global credit and domestic market performance. The proactive strategist anticipates the next 6-month cycle, shifting focus from reacting to current headlines toward positioning for the next regime. The noise of the market will only get louder. Surviving it requires the discipline to stop looking in the rearview mirror and the use of a framework like the monthly macro map to navigate the road ahead.